Hi, everyone. Welcome to United Assets second quarter investment call. As usual, I'm joined by Tom and Jiorden from our investment team. I have a lot to go through with moving markets and expectations, but to start, I'll turn it over to Jiorden for a recap of the quarter's performance.
Thanks, Matt. So quickly turning to Exhibit 1, we chart returns for major market indices for the second quarter and year to date. As you see, the stock market continues to be the highlight, with the S&P 500 up 4% for the second quarter and 15% for the year so far. But as we've discussed in our prior videos, much of these returns continue to be concentrated in the Magnificent Seven, which now make up over 30% of the market and were up 16% in the quarter. As also seen in the exhibit, during the second quarter, we saw more muted returns for the typical stock, as measured by the S&P 500 equal weight, and the overall bond markets, as measured by the Bloomberg Ag and Muni indices. Now moving over to Exhibit 2, we show returns for these same indices, but instead over the last 6 quarters and 30 years to make a key point. While market breadth has been narrow for some time, that says more about the outsized strength of the Magnificent Seven than any particular weakness elsewhere. So over the last year and a half, you really do see that the typical stock and the bond market have generated returns that are in line with their long-run averages. So the upshot here is that this narrow breadth has not detracted from the success of our clients' financial goals, as there have been no shortage of securities that meet their targeted rate of return. Now into year end, we're going to be focused on the September Fed meeting, the November presidential election, the trajectory of economic data, and the market's elevated concentration levels. So for an update on the economy to start, I'd like to turn it over to Tom.
Thank you, Jiorden. Just to give a quick update on the economy, we're definitely getting mixed signals. When you look at, for example, the Atlanta Fed GDP now, which looks at a real-time updates on GDP, for the second quarter, that came in at 2.7%. And right now for the third quarter, it's up 2.9%. So that sounds very strong. However, when you look at, for example, the Conference Board Leading Economic Indicator Index, that is actually calling for a decline down to about 1% in GDP throughout the quarter. In addition to that, if you look at like the Citi Economic Surprise Index, that's actually in negative territory. And what that does, it looks at how are the data being reported compared to expectations. So what we've seen more recently is the data is coming in below expectations. And I think that's one of the reasons that markets have gotten a bit rattled. But what we see here on Exhibit 8 is that right now there's about a 30% chance from a consensus perspective of a recession, which is a bit higher than the median, which is closer to 20%. But we've seen that it had come down from higher levels last year. So again, I think that the message is mixed, but we're not seeing at this point something that says we're in a recession at this point. However, I think one of the things we should be focused on is what the Fed is thinking about the economy. And for that, I'll turn it over to Matt.
Thanks, Tom. As it relates to the Fed, they've been more intently working on the inflation side of the dual mandate for a while now. So with the worst of inflation likely behind us, the Fed has been expected to begin cutting rates in the second half of the year. The number of rate cuts anticipated, however, has fluctuated throughout the year, and this continued in Q2. Early in the quarter, we had inflation readings that were a little bit higher than expected, and that caused the market to really pull back on the amount of rate cuts that were expected. But as the quarter progressed, inflation readings came in a little bit softer, and we saw those expectations change again. So as we stand now, the market is anticipating about 4 interest rate cuts by the end of the year, and that's actually off from the Fed's most recent projections, which indicated about 1 cut by the end of 2024. So that's something that's bouncing around a lot. It's something we're closely watching. But another part of policy that's obviously very important coming up is the fiscal side. So I'll turn that back over to Tom to give us some more color there.
Okay, thanks, Matt. Obviously, we're in what I would consider one of the most unpredictable election cycles of our lifetimes. as a result of that, we've seen things like the polls and the betting odds move substantially. If you think about it, just in the last 2 months, we've had a real game-changing debate, followed by an assassination attempt on one of the candidates, following that with the withdrawal of the other candidate. And through that process, we've seen a real movement in what we call the betting odds, the odds of who's going to win the election. More recently, with both candidates solidified, having announced their vice president candidates, we've seen those betting odds move closer together. But I think what's more important is to take a step back and look at, investing around elections. So what we show here is Exhibit 9 is if you look back through 1992, this is the volatility index. What we've seen is starting around now, which is consistent with what we've seen in the last week or so, volatility tends to move up, no matter what the outcome might be going into the election. And so we would anticipate that would continue. But post-election, no matter the outcome, whether it be the incumbent wins, whether the challenger wins, whether there's a sweep on either side, volatility tends to go down because there's more certainty as to the outcome. Conversely, if you look at returns and going back to 1928, going into the election, returns can be somewhat choppy, but post-election, and you can see that in Exhibit 10, under every construct, again, whether the incumbent wins, whether the challenger wins, whether there's unified one-side sweeps or there's divided, the S&P 500 continues to go up. And that speaks to us about not taking dramatic actions around the election. I think from our perspective, we're looking at the policy implications that could occur as a result of the outcome and making tactical shifts in sectors and or stocks in order to reposition portfolios appropriately. But in our mind, policy is just one input into the investment process. Things like rates, valuations, I think are also critically important. And for that, I'm going to turn it over to Jiorden.
Thanks, Tom. So, as Matt indicated earlier, there are definitely growing expectations for the Fed to cut rates later this year. And that'll obviously have implications for financial markets more broadly. That said, we do believe it is why the Fed lowers rates, not just if it lowers rates, that really matters. With the health of the economy really the key determining factor. So with that, let's pull up Exhibit 7. This charts the historical stock market performance in the months surrounding the first rate cut. And I'd like to draw your attention to the three bold lines. So the black bold line is the average of all prior instances and shows fairly muted returns in the months surrounding that first rate cut. Still, we see much stronger returns if the Fed is doing so outside of a recession, which is that green bold line, and negative returns if the Fed is doing so to address a recession, which is that orange bold line. So the economy is really the focus here. And while it's been surprisingly resilient, as Tom talked about earlier, the path from here is still a little cloudy and uncertain. So as we've noted in the past, an example of how we're managing around this uncertainty is through an underweight to cyclical sectors, but an overweight to small cap stocks. Both categories are sensitive to the economy, but with small cap stocks at a much more attractive valuation relative to cyclicals, we see the potential for small caps to have more upside if we end up being in a very strong economy, but less downside should we enter a recession. So to see another example of how we're managing around this macro uncertainty, I'll turn it back over to Matt, who will discuss bonds and fixed income. Thanks.
Yeah, thanks, Jiorden. On the fixed income side, we believe that very good quality, longer-term bonds will outperform in a slowing economy. And this will generally provide a very good hedge to clients that have balanced portfolios and also owning equities. As you can see on the chart on the right, long-term treasuries, which are indicated in yellow, tend to appreciate as a recession takes hold, while stocks are typically going the other way. These bonds are generally beneficiaries of a flight to quality bid, and they also benefit from the Fed lowering rates, which typically happens during a recession. With this in mind, as the market was bouncing around and trying to price out the amount of rate cuts this year, interest rates actually lifted a little bit early in the quarter. So we took that as an opportunity to extend duration a little bit through high quality bonds. And the two that we chose this quarter were agency MBS and also U.S. TIPS, or Treasury Inflation Protected Securities. So these are both very high quality. They contain little to no credit risk and should be beneficiaries in the event that the economy slows and or the Fed is cutting rates. So even though there's not a lot of action in credit spreads and we're not seeing many opportunities there, we continue to see reason to be active in our fixed income portfolios. And these are just a couple examples of that. So for a bigger view on the equity side of things, I'll turn it back over to Jiorden.
Thanks, Matt. So I'd like to take a minute here to just touch on the recent market concentration we've seen and diversification. Now, diversification is commonly discussed in a risk management context, but we'd also like to present a couple of potential offensive cases for our more diversified portfolio construction from here. So really quickly, today, the top 10 stocks count for about 35% of the total market. And that's owing to the large weight of the Magnificent Seven. That is historically high. I mean, we've seen that go as high as 25% in the early 2000s and 30% in the mid 60s. Now, let's pull up Exhibit 11. This exhibit charts the weight of the top 10 stocks in the S&P 500 against the alpha of the typical stock, as depicted by the S&P 500 equal weight relative to the market. Now, during periods of increasing concentration, much like the ones we've been in for the last 1 to 2 years, we see narrow market breadth with the typical stock underperforming the market. On the other side, during periods of declining concentration, we see broader market breadth with the typical stock outperforming the market. Now, with concentration at historic highs, odds are we experience some period of declining concentration and broader breadth going forward. And we think that bodes well for the typical stock. Now, moving over to Exhibit 12 on the right side of the slide, we make a bit more of a fundamental case for the typical stock and our diversified allocation. As highlighted on that left slide, on the left of that exhibit, the market is currently trading at 21 times earnings, and that's expensive historically, owing to the premium multiples of the Magnificent Seven. The typical stock, however, trades at a much more reasonable 16 times multiple. And then, as highlighted on the right side of that exhibit, the relatively attractive valuation of the typical stock comes despite an expectation for accelerating earnings growth in 2025 and 2026. So all that said, we believe the combination of a declining market concentration from peak levels and an attractive mix of valuation and growth for the typical stock do bode well for our more diversified portfolio construction, especially when compared to a more concentrated passive indexing approach. Further, we do see potential catalysts in the event the Fed lowers rates alongside a healthy economy, which could be a rising tide that potentially lifts all boats. But with that, I'll turn it back over to Tom to close out and address some planning items as well as some firm updates. Thanks.
Thanks, Jiorden. Well, as you can see, there's a lot of information that the team is parsing through in order to come up with the analysis and managing portfolios. And for additional information, I'd point you to the letter which accompanies the video, which goes into each of these things in more depth. I would also note in the letter, we have an update from our planning team on the future of Social Security, talking about where it may go, and then strategies around optimizing your Social Security strategy, because it's different for everybody. So I'd point to that, and as well as the fact that we continue to grow, and as a result of that, we continue to expand not only as we have into New Jersey, but also with our team. And so I'm proud to announce that we added Jacob Geis here in the second quarter. He's a member of the client experience team and continues to build out what we want to make sure is a great experience for all of our clients. So we're glad to have Jacob aboard. With that, I think we're going to wrap it up, and we appreciate your time and attention and look forward to seeing you again next quarter. Thank you.